Risks, though, come hand in hand with opportunities, and I, for one, am excited to monitor the global order for trade, treasury and payments and see how it evolves in the following 4 years.
In terms of trade finance, I think what we're probably going to see is demand falling.
The regions which have built a regional infrastructure or architecture consider this option. So this will be the European Union, ASEAN, Southeast Asia, the emerging African bloc, and also potentially the Gulf Cooperation Council.
I think there are several things here. I mean, the reason why you're seeing the reaction in markets that you have seen is partly because of the Elon Musk thing around deregulation. So you've seen a huge potential for banking stocks and large corporates.
Obviously, we are expecting a stronger dollar here. It's already happened today. I said EM currencies have taken a knock. Stronger dollar seems to be the outcome of a Trump administration.
I'm Dipesh Patel, editor at Trade Finance Global, and joining me today are a distinguished panel of experts. We have today with us Rebecca Harding, economist at Rebeccanomics, Robert Besseling, CEO at Pangea Risk, Alisa DiCaprio, former chief economist at R3, and Simon Everett, a trade policy expert.
Welcome to Trade Finance Talks, your go-to trade, treasury and payments podcast, brought to you by TFG.
Election interference was a factor in Donald Trump's 2016 victory. People were confused at the electoral system, how Hillary Clinton won the popular vote, but not the presidency. But this time around, Democrats have fewer things to point at. The American public has decided that Trump's campaign warranted his win. His economic mandate of massive tax cuts and protectionism, protect American jobs and industries, has evidently been popular. So let's now dive into what this could mean for international trade. Alisa, I'm going to start with you, if that's okay. This is going to be Trump's second term as US president, his first term ending in 2021. Broadly, and for the listeners' benefit, what's Trump's trade policy and how does it differ from Biden's?
It's more of a change in magnitude than a change in direction. What we saw is a lot of the policies that happened under the first Trump administration have continued under Biden. But I think we will see 4 shifts. And the first is really around more restrictive tariffs for everyone. So the campaign has suggested 10 to 20% tariffs on all imports, as well as increased enforcement of trade rules. So we're going to see trade become much more restrictive. The second shift is around de minimis increases. So this is really going to increase the costs for any company that is involved in low value import trade. Right now, the de minimis result for the US is $800. And this limit was begun under the Biden administration, and we expect it to continue under the future administration. The third shift is really around aggression against China. This was continuing with both administrations as well, but the campaign is claiming 60% tariffs against imports from China, revoking MFN, and we're likely to see increased techno-nationalism as a result of that. And finally, the fourth shift I think we're going to see in terms of magnitude is really around dismantling or an attempt to dismantle the international economic architecture, which is something we need to pay attention to. So we saw that in the previous administration where he blocked a lot of the different activities in the WTO. This will absolutely continue. Even though the campaign says that there is going to be all these restrictions, congressional Republicans are likely to moderate his most extreme proposals. Not the direction, but certainly the magnitude. So it remains to be seen exactly how these will play out.
Thanks, Alisa. So generally, we're heading in the same direction, but that direction is accelerating. Let's circle in on that, dismantling the economic architecture and what that means for trade. Perhaps, Rebecca, let's start by talking about US and China trade relations. We've regularly spoken about economic wargaming. During his first term, Trump increased tariffs to something like 818 categories of tariffs on Chinese goods worth some $50 billion US. It's been interpreted as a trade war, a war which he has promised only to escalate. Rebecca, what consequences do you anticipate from Trump's policy on tariffs?
The simplest way of answering that is just to say this is a grey rhino. Insofar as in foreign policy and trade terms, we've seen this coming down the track. It's been predictable for the last few months. It's one of the reasons why economic warfare and economic gaming has become more important. Now, what I think we're likely to see from all of this, the US actually becoming more isolationist. I think that's one of the things that actually is a likely outcome of all of this, because the problem that we have at the moment is a geopolitical situation. As Alisa said, the global institutions of trade and foreign policy are substantially weakened over the last few years. We've seen the weaponization of trade, and we've talked about all that trade being used strategically. And I think actually what we're likely to see from now on is increased isolationism, the United States actually thinking more about its own competitiveness and its own place in the world, which is defined on Trump's terms rather than anyone else's. And I think where we're likely to go from there is actually Europe having to refocus on itself, and the UK and Asia having to refocus on themselves to a greater extent, because America will be thinking about itself in the next few years.
Thank you very much, Rebecca. Robert, let's switch to you, I guess, with that Africa and Middle East angle. How might a second Trump presidency impact trade relations between the US and Africa and the Middle East, which obviously you cover very extensively at Pangea Risk? And is this election outcome going to heighten geopolitical risks associated with potential trade disputes that we're already seeing in the region?
Good morning, good afternoon, everyone. Yeah, at Pangea Risk, we cover emerging and frontier markets across Africa, the Middle East, and Asia. And what we've seen in terms of market reactions here, that across the emerging markets, currencies have taken a knock. And really, we should not be too surprised about this. Not because of the transition in the White House administration. That was basically factored in already to a certain extent. What has not been factored in is the strength of the red sweep across the US, particularly also there will be a congressional change as well. And that has not been factored in terms of the African Growth and Opportunity Act, which is a key piece of legislation that benefits many African countries. I'm joining you from South Africa today, where the AGOA Act accounts for about 13,000 jobs. It's worth about $3.6 billion in exports annually. This is important for an economy like South Africa and others across the continent as well. That piece of legislation is coming up for renewal in the next year, and it is Congress that will decide whether it will be renewed, probably will be, but it might be reformed and there might be new conditions imposed here. Countries that cozy up too much to US enemies or are trying to circumvent sanctions may not see a AGOA renewal. That said, there will be a level of continuity here. Both the outgoing administration and the incoming administration are seeking access to critical minerals to drive the green energy transition, but particularly these electric vehicle manufacturers that, after all, were very important in the Trump campaign. So therefore, key landmark pieces of infrastructure like the Lobito corridor in Congo and Angola to get copper and cobalt to international markets will be continued. Other initiatives like Prosper Africa was a Trump initiative anyway. It was strengthened under the Biden administration. Unlikely to see much change here. So there's a level of continuity in Africa. In terms of the Middle East, a bit of a mixed bag here as well. I can certainly say it's no coincidence Israel decided to dismiss the defense minister at the same day as the US elections. That will certainly encourage the Israeli administration to galvanize their ongoing policies. As I said, it's a mixed bag. Under the Trump administration, the Abraham Accords to normalize relations with Israel and to seek a standardization of relations to benefit trade and investment across the Middle East were commenced. So an improvement of relationships with Saudi Arabia are on the card. And more generally, across Africa and the Middle East, we will see a more transactional nature of geopolitics that actually could benefit trade and investment.
Thank you very much, Robert. Transactional, I guess bilateral, not multilateral. Let's turn the discussion over to Simon. Multilateral trade agreements have been on a decline since 2017 because of Trump's influence. He famously withdrew from the Trans-Pacific Partnership and replaced NAFTA with the USMCA agreement. Simon, how might his return affect ongoing negotiations and existing trade pacts?
Well, look, I think the key point here is that the Biden administration didn't sign any trade deals, so there's none for Trump to tear up. Remember, he tore up the Trans-Pacific Partnership because he thought Obama had negotiated a lousy deal. So there's nothing that can be immediately reversed there. But what is vulnerable is probably the US free trade agreement with Korea. Korea has a number of trade practices which I think the incoming administration might find problematic. And the other area which is important is going to be the renegotiation of the USMCA, or the North American Free Trade Agreement upgrade, as it's called, which will call into question the relationship between Canada and Mexico and the United States. Now, I think in both of these cases, it's not a done deal that they will be scrapped. There will be commercial pressures and also possibly diplomatic offers from both sides for other countries to Washington. So these deals may be salvaged, but they may have to be rebranded and repackaged on terms that the incoming president finds agreeable. And of course, he does like to declare victory in these respects. The one other area where there might be an agreement, might be a negotiation, not necessarily an agreement, is a possible phase 2 deal with China. Trump administration, there would be a phase 2 deal. It never came to pass. And maybe the idea for that could be revived again under different circumstances and contexts.
Thank you very much, Simon. So eyes on Korea, eyes on China. Let's talk about the markets. This morning, the FT has reported that stocks in Tesla and US banks have surged. I think JP Morgan, Citigroup and Bank of America have rallied 7% overnight. But in contrast, European renewable stocks have slumped. The S&P Global Clean Energy Index, which tracks the world's largest clean energy companies, was down almost 2%. Even as the overall index went up. Rebecca, how might Trump's stance on climate change and energy policy impact global commodity markets and trade flows?
I think there are several things here. I mean, the reason why you're seeing the reaction in markets that you have seen is partly because of the Elon Musk thing around deregulation. So you've seen a huge potential for banking stocks and large corporates, their share prices to rise for the very simple reason there will be a big deregulation element to Trump's economic policy. But if we look specifically at commodities generally and then sustainable commodities in particular, I think it's very unlikely that Trump will kill the Inflation Reduction Act immediately. It's been responsible for relocating a lot of sustainability assets to America, and getting rid of that straight away is probably something that won't happen. But I think more importantly, his focus on fossil fuels and his focus on the oil and gas in particular has kind of spooked the sustainability markets for a while. And that's why you're seeing the reaction today. I think a lot of the reactions today, though, you have to see being tempered over time, because we've seen commodity stocks fall initially as well, generally fossil fuels, because of the reduced or the prospect of lower trade because of all the tariffs. So I think that's an issue that we need to be thinking about. There's a reaction today, then there's a longer term, more tempered reaction that's going to happen for the very simple reason that Trump is a bit of a wild card. He says one thing during the election campaign, but as Alisa said at the beginning, there is going to be Congress that will modify, but there's also an extent to which he won't necessarily use all of these measures, some of them because he's transactional will be used as a bargaining chip.
Hey, enjoying this podcast? Hit that follow button for more. Done? Let's get back to it.
Very good point. Is a lot of what he's saying rhetorical, or will it come to fruition? Alyssa, it's time for your crystal ball moment. What can we expect Trump's impacts to be on access to trade finance and supply chain finance?
I think in terms of supply chain finance, we're going to see increased demand. The reason for that is because we're going to see increased costs for firms because of tariffs, and increased need for capital investment because there is this big policy about reshoring. And so if companies are going to reorganize their supply chains yet again, there will need to be some assistance for that. There's going to be a big altering of cost structures. Now, in terms of trade finance, I think what we're probably going to see is demand falling, because when you're talking about letters of credit, you're often talking about demand for a trade between, say, the US and an emerging economy or a new exporter. They're the types of people that you see using trade finance. So we're going to see that fall as tariffs rise. And certainly there's an increased risk of regulatory compliance, which is also going to change how firms engage with tariffs. Because we know that when preferential tariff regime becomes more complex, firms just don't use tariff preferences. They kind of default to using whatever the standing tariff is. So I think we are gonna see a decrease in trade finance and an increase in supply chain finance for those reasons.
Thank you very much, Alyssa. Decrease in trade finance, increase in supply chain finance. Let's go back and talk about trade policy. Simon, What regions are likely to be singled out from a more combative trade policy? And what methods are there for assessing and monitoring as the effects of Trump become realized?
On this point, the Trump team previously and during the campaign has made it clear what they dislike. They dislike countries with large bilateral trade surpluses with the United States. They dislike countries which devalue their currencies or gain some what they see as artificial advantage either through currencies, subsidies, lax regulations and alike. And they also dislike countries which don't enforce intellectual property rights laws and other standards. And so you can go through a list of all the different factors which the Trump people dislike and then benchmark countries against that. If you do that, and I did that very recently in a note which I sent around, you'll find the top of the list of countries in terms of red flags is Korea, followed by China, India, Japan, and then ultimately the European Union as well. So these are the countries which are going to be in the firing line. Of course, Canada and Mexico get special treatment because of their relationship with the United States through USMCA, especially with respect to Mexico. There are big concerns that the Chinese are investing in Mexico to get tariff-free access in the United States, and Donald Trump said that he wants to stop that. So I think one can use objective grounds to identify which countries are likely to face trade tensions, and they, of course, will be assessing how to mitigate that risk. Companies, of course, exporting from those countries would be well advised to think about what alternative plans they have for supplying the US market should trade tensions deteriorate.
Thank you very much, Simon. And to our audience, if you have any questions, please respond on LinkedIn, on YouTube, on x.com, and we will endeavor to ask our panelists in the few minutes we have remaining. One final question now to you, Robert, before I turn to the panel for a wider question. What do you think the impact of protectionist trade will be on currency markets and international capital flows?
Great question, Dipesh. I mean, obviously, we are expecting a stronger dollar here. It's already happened today. I said EM currencies have taken a knock. Stronger dollar seems to be the outcome of a Trump administration, and that will have an impact in terms of global trade tensions. Just a few weeks ago, many of us were attending the IMF and World Bank annual meetings, where at the same time, the BRICS Club was meeting in Russia. That much was achieved at the BRICS Club. Certain really interesting developments happened. One, the BRICS Club is expanding. We've seen more partners across emerging markets now joining the BRICS organization. And similarly, we've seen these emerging markets seeking alternatives to make trade happen in local currency, pushing ahead with a local currency clearance system called BRICS Clear. They have rejuvenated BRICS Pay, something which these countries have been playing with since 2018. None of that has a realistic timeline for rollout yet, because there are different political agendas at play here. But that said, a stronger US dollar will certainly motivate more of these emerging markets potentially to join the BRICS and to join more local currency transactions. That may also inflate, a US stronger dollar may also inflate the borrowing costs for many countries in emerging markets, like in Africa, like in Asia, which are already struggling to meet debt servicing obligations. That said, must be mentioned that on the other hand, the previous Trump administration put in place some very serious risk mitigation instruments to help US companies deal with some of this country risk. For example, the US DFC was created under the previous Trump administration, and that really gave a boost to help companies operating in places like Africa, the Middle East, or emerging markets in Asia. There are some measures that are likely to be implemented here to offset some of these risks and trade volatilities.
Thank you very much, Robert. Simon, I'm going to turn to you with a question from Jack Stone from the audience. What are the most damning and immovable red flags with regards to Korea, China, India, and Japan, probably in relation to the reference paper you launched earlier, that are likely to complicate trade relations with Asia and the US?
There are several. So the first is that these countries have, by and large, quite entrenched and bilateral trade surpluses with the United States, which are well above $10 million. Secondly, they also have policies which impede the exports of goods from the United States to their home markets. And these are sometimes formal barriers, sometimes more hidden barriers, sometimes support to import competing firms. Third, in the case of Japan, Japan has benefited significantly from a major reduction in costs driven largely by exchange rate changes. This is a factor which worries them as well. Fourthly, in all four cases, there is a legacy of American trade complaints which have been documented in the National Trade Estimates reports, and these often refer to deep-seated features in their economic models. And lastly, in the case of some of these, in particular, the case of India, there are also significant tariff level differences between the United States and the tariffs which are paid going into India. So when you put those things together, these are the factors. Some of these factors can be very easily fixed by the trading partners, some cannot. And I think that speaks to the risk which is there. And I imagine these countries are evaluating how vulnerable they are in the days and weeks ahead.
Thank you very much, Simon. I think 2025 is certainly going to be about building resilience in supply chains. I'm going to pass the next question over to Rebecca Harding. Question from Baraka. Trump spoke about oil and gas, went further in his preparation to take advantage of them. What do you think that will have in terms of impact to commodity prices in 2025, Rebecca?
As I said before, it's very hard to predict exactly what will happen because of Trump's wild card effect. If you look at it just in terms of facts that we have at the minute, President-elect Trump is somebody who supports the oil and gas industry. He has supported exports of oil and gas. He has supported development of oil fields and gas fields. All of that starts to allow America to have a role in global oil and gas markets that it's been developing. And so it politicizes commodities, but it also potentially pushes up commodity prices because it means that America can hold back on things like gas, hold back on things like oil, actually begin to manipulate markets to a greater extent than it has done even up to this point. I think the role of America in commodity markets is like to become a lot more dominant because we are seeing trade fragmentation and because we are seeing the separation out of the critical minerals supply chains, the dependencies, all of those types of things which will affect our transition. We're going to see a much more complicated commodities picture in the years ahead.
Thank you very much, Rebecca. One more question for Simon. With the comeback of Trump, what is the geopolitical scenario awaiting us? Are we more likely to observe a retreat towards regions, I guess a regional trading bloc? And I'm going to repeat that question to Alisa to finish. So Simon, over to you first.
Broadly, yes, in the short term. The regions which have built a regional infrastructure or architecture consider this option. So this will be the European Union, ASEAN, Southeast Asia, the emerging African bloc, and also potentially the Gulf Cooperation Council. In different ways, those regions may look at each other and say, look, we have an option if the global context deteriorates. The only wild card to add to this is were there to be some type of major military action which involved either an attack on NATO or reunification by force of Taiwan, then there could well be a hard block scenario where there's even greater fragmentation as well. So those are the two scenarios going forward. At the moment, we're, I guess, outside both of those, we're waiting to see just how combative the line taken from Washington is going forward.
Alisa, I'm going to expand on that question because I think it's likely we are going to see a retreat towards regions. But what do you think regional trade blocs are going? How do you think they're going to impact access to trade finance, trade flows, and supply chain finance?
I'm actually not sure we're going to see that much of a retreat to regions. I think I disagree with that premise because if you look at what's happened, particularly with the new internet-based technologies that we have in the international economy, we're seeing a different type of regional aggregation, which is not necessarily geographic. So if you look at the Enbridge project, for example, those countries are not natural trading partners, but they're cooperating together and they're building infrastructure together. I think we're going to see a very different regional architecture. And I think what's happening is going to become America first, not allies first. So I think that will be seen by all of our trading partners as a reason to sort of strengthen their alliances with their neighbors to get to the point of the regionalization component of this. And in terms of trade finance and supply chain finance, how that will be affected, we really need to think about if there's going to be changes in country risk, in bank risk. So are the limits going to change for what we have and the extent to which there's reshoring into the US? Because those products that companies will demand for local suppliers or domestic suppliers will be very different from what they would demand for international suppliers. And we really need to see what types of products they're going to be.
Thank you very much, Alisa. I'm afraid that's all we have time for. So I'd like to thank Rebecca, Robert, Alisa, and Simon for your time today. He's not only been president for a few hours, but on Trump's economic policy, there's already everything to speculate about. Our panelists have outlined some fascinating risks to look out from letter of credit and traditional trade finance demand in emerging markets falling as tariffs rise, to a stronger US dollar making it difficult for emerging markets to meet debt servicing obligation. Risks, though, come hand in hand with opportunities, and I, for one, am excited to monitor the global order for trade, treasury, and payments and see how it evolves in the following 4 years. It's been a long, heavy day of geopolitical and macroeconomic talk. Thank you to everyone for tuning into our discussion, and there'll be much more to come. Thank you to our amazing panel of experts. Good afternoon, good evening, and good night, everyone.